Recording in progress.
Wraparound mortgages explained. Real estate investors often find it helpful to have a wide range of financing options available. Not only do traditional lenders have stringent eligibility requirements, but the approval and closing process can sometimes take too long to catch a deal. This is where investors find alternative financing options helpful. One financing option is the wraparound mortgage. What is a wraparound mortgage? A wraparound mortgage, commonly referred to as a wrap loan, is a category of loan that encompasses the outstanding debt due on a property, plus the amount that covers the new purchase price. Wraparound mortgages are considered a type of junior loan or second mortgage, as the loan is taken out while using the same property as collateral. However, there are subtle differences between a wraparound mortgage and a secondary mortgage. Both wraparound mortgages and second mortgages are types of seller financing. With a second mortgage, the interest rate is higher and the borrowed amount is lower compared to the original mortgage. Although wraparound mortgages are often referred to as a type of second mortgage, there are some subtle differences. A good way to understand the difference is to look at what happens to the original loan's balance due. A wraparound mortgage includes the original mortgage payment that is rolled into the wraparound loan payment. The balance due on the original mortgage remains the same. In contrast, the original mortgage balance and new selling price are combined with the second mortgage to create a new outstanding balance. How does a wraparound mortgage work? In a traditional scenario, the buyer purchases the home by taking out a mortgage through a lender. The lender is typically a financial institution, such as a bank or a mortgage company. The seller uses the sale proceeds to pay off any remaining mortgage on the home. In a wraparound mortgage financing model, the seller acts as the lender and offers financing directly to the buyer. They keep the existing mortgage on the home and use payments from the buyer to pay it off. The seller often charges a higher interest rate on the loan and pockets a profit from each installment payment. To facilitate the wraparound mortgage, both the buyer and the seller must agree on a down payment, interest rate, and loan amount. They'll both sign a promissory note that lays out the term of the wraparound loan. They'll also sign over the title and deed from the seller to the buyer. Once this process is complete, the seller no longer owns the home, but they are responsible for taking mortgage monthly payments from the buyer and making payments on the original mortgage. If the seller fails to make mortgage payments, the original lender retains the right to foreclose on the property. For example, Mr. Seller recently listed his home on the market for $500,000. He still has a remaining balance of $300,000 on his mortgage at 5% interest, making his payments roughly $1,600 per month. Mr. Investor comes along and offers to put $50,000 down. Mr. Seller and Mr. Investor agree to finance the remaining $450,000 through a wraparound mortgage at 6%. Moving forward, Mr. Investor sends Mr. Seller a check for roughly $2,600 per month. How common are wraparound mortgage loans? Wraparound mortgages are not common, and this is mostly because the original lender has to sign off on this secondary form of financing. If the lender requires that the original loan is paid off before the seller is eligible to sell the home, then a secondary or a junior mortgage may not be feasible. The popularity of wraparound loans increases or decreases along with the housing market. When interest rates are low, demand for wraparound mortgages is also low. This is because buyers with lower than average credit scores or income levels usually face high interest rates. When interest rates are low, they have a better chance of qualifying for a traditional loan. But when interest rates are high, there may be more demand for unconventional financing. Buyers may want to take advantage of a wraparound mortgage when they can afford or can qualify for a traditional mortgage. They also might consider a wraparound loan when the interest rate is better than what they could get on a traditional mortgage. Also, in a seller's market, a seller will easily find buyers and lucrative offers. They may only be interested in offering seller financing in a buyer's market and are looking to increase their options. What are the risks of wraparound mortgages? With any type of investment scenario, there's always a certain level of risk. Some risks are number one, risk of foreclosure if the seller does not use payments towards the original mortgage. Number two, the seller's lender can demand repayment in full if the property is sold. Number three, the seller has an incentive to charge a higher interest rate to the buyer. Number four, in the case of a foreclosure, the payoff of the original mortgage will be prioritized. What are the benefits of wraparound mortgages? The main benefit of a wraparound mortgage is the ability for an investor to purchase property, even if they have poor credit. Wraparound financing is an arrangement made directly between the buyer and the seller, creating a space for negotiable terms and faster decision-making. Number one benefit of wraparound mortgages: option to purchase property even with bad credit. Number two, ability to avoid having to go through a traditional lender. Number three, faster purchase process with negotiable terms. So, to wrap it up, a wraparound mortgage is a type of junior loan or secondary mortgage that allows buyers to purchase a property without going through a traditional lender. Depending on the terms negotiated directly between the seller and the buyer will typically pay a monthly mortgage amount directly to the seller, typically at a higher interest rate than the seller's original mortgage on the property. This way, the seller is incentivized by the ability to pocket a monthly profit between their original mortgage payment and the wraparound mortgage payment. Buyers are incentivized by the ability to finance a property purchase, even if they would not have been qualified if they were to go through a traditional lender. There are both risks and benefits that both parties should consider before going into a deal. And that's Wraparound Mortgages Explained. Be sure to like and subscribe to catch the next New Day Property Redevelopers video.